So how does a real estate investment get funded? Well, that's typically called the capital stack. The capital stack is when you have capital inside of a real estate investment that consists of debt, usually coming from bank loans or from a debt lender, and equity. The debt lender usually makes up the majority of the capital, anywhere from say 50 to 75% of the total money. And then the equity makes up the other, let's say 25 to 50%. The debt sits ahead of the equity in the capital stack and is usually paid back first. It also receives an interest rate, and it usually can take the property as collateral. There also may be recourse loans on the debt, which means that if the property's value returned back to the bank and for any reason it has to foreclose, if it doesn't make up the total amount of principal that's owed on the loan, then the lender can go after the personal guarantee off of the developer, sponsor, whoever guarantees the note. The equity is made up of typically the preferred equity and the common equity. And so the preferred equity sits ahead of the common equity. It's usually paid a fixed return. That fixed return sits behind, and that preferred equity stack behind the debt. And then you have common equity, which is usually made up of our general partner or sponsor. And then you have that, and the other part is your limited partner. So we'll get into that more when we talk about the common equity and how that's broken out. But for now, just know that the debt is usually the biggest piece of the pie, gets the lowest amount of return. The next step is going to be usually the preferred equity in the equity stack, and then the common equity. And so the lowest risk is at the bottom with the debt. They get paid the lowest, and that risk goes up with higher returns as you go up through the capital stack to the top, which is where usually the equity and the common equity sit.